Welcome to a deep dive into the world of taxation and wealth, where we explore how some of the richest individuals and corporations manage to legally reduce or avoid paying taxes. In this video, we'll shed light on various tax avoidance strategies with real-life examples, all within the boundaries of the law. We'll also discuss the broader implications of these practices on society and the economy. So, let's dive in. Our journey begins with the concept of tax havens. These are countries or territories that offer favorable tax conditions, such as low or no income tax for individuals and businesses. One of the most well-known examples is the Cayman Islands. In the Cayman Islands, there are more registered businesses than residents. One of the most notorious cases is the Ugland House, a small building that houses thousands of businesses. By setting up subsidiaries in tax havens, corporations can legally reduce their tax liabilities. Wealthy individuals often utilize offshore accounts to shelter their income from taxation. An example of this is the Panama Papers scandal, where millions of leaked documents exposed how individuals and companies used offshore accounts in Panama to hide their wealth. Prominent figures like politicians, celebrities, and business magnates were implicated in the scandal, highlighting the widespread use of offshore accounts to minimize tax obligations. In 2018, Shakira's use of offshore companies to manage her global music business prompted a tax evasion investigation in Spain. In July 2021, a Spanish judge ruled that there was sufficient evidence that the Colombian-born singer had failed to pay $16.4 million in taxes between 2012 and 2014 for her case to go to trial. Her representatives have mentioned that the singer used offshore companies because most of her income comes from outside Spain, and that Spanish tax authorities are aware of all of her companies. The case is still ongoing, but it appears Shakira is still liable to pay around $15 million for defrauding Spain. High-earning individuals can also leverage tax credits and deductions to their advantage. One well-known example is Warren Buffett. Warren Buffett, one of the world's richest individuals, has frequently pointed out that his effective tax rate is lower than his secretary's due to the lower tax rate on capital gains and dividends. He advocates for closing this tax loophole. The biggest reason that Buffett pays so little in taxes is because a significant portion of his income comes from capital gains, which are taxed at a lower rate than ordinary income. Capital gains tax rates are currently set at 0%, 15%, or 20%, depending on your income level and the length of time you hold on to your investments. This means that if Buffett sells stocks or other investments that he has held for more than a year, he will pay a lower tax rate on the profits. Buffett is also well known for his philanthropic efforts. This saves him big tax time. Through his charitable giving, Buffett can reduce his taxable income and therefore his tax liability. By donating appreciated assets, such as stocks or real estate, to charity, he can avoid paying capital gains tax on the appreciation and receive a deduction for the full fair market value of the donated asset. While charitable donations are essential for societal good, some critics argue that they can also serve as a tax shelter. Take, for instance, the Bill and Melinda Gates Foundation. The Gates Foundation, despite its philanthropic efforts, has faced scrutiny for investing in companies that might not align with their charitable goals. This allows them to grow their wealth while reducing their tax liability. This begs the question whether billionaires show their charitable solidarity out of goodwill or because it benefits them financially. I'll let you decide. Better yet, comment below on your opinions. We are often amazed when we see rich people buying paintings for millions of dollars. But have you ever wondered why they pay such a ridiculous amount of money for art? The reason might not lie in the art, but in the tax itself. Let's say you are a billionaire and you don't want to pay millions in taxes. So to avoid this, you will buy a painting worth $20 million. Then, you send the painting you purchased directly to a free port to avoid paying both sales and use tax. Many collectors use free ports for storing their art. If you send the art you purchased directly to a free port, you'll avoid paying both sales and use tax. Keep in mind, however, that as soon as the artwork leaves the free port and gets delivered to a new location, taxes will have to be paid at the usual rates. But if you are buying art as an investment and you have no intention of hanging it at your home, you can resell it directly from the free port to another collector without paying for sales and use taxes whatsoever. Filing for bankruptcy is another great way of reducing your debt and avoiding tax. Filing for protection from your creditors under the federal bankruptcy law will generally stop bill collectors from harassing you and give you relief from many of your debts. However, tax debt is treated differently from other kinds. In bankruptcy jargon, taxes are usually treated as a non-dischargeable priority debt. This means bankruptcy won't eliminate them, and repayment of the debt is given priority over other creditors' claims. Still, there are times when taxes can be considered a dischargeable debt that can be eliminated with a bankruptcy filing. The first requirement for dischargeable tax debt is that it be income tax debt. Specifically, this would include unpaid federal and state income taxes, but not, for example, back payroll taxes, such as withholding for Social Security and Medicare. A second condition is that the tax debt can't be too fresh generally, newer than 3 years. To be more precise, the original tax return must have been due at least 3 years before the date of the bankruptcy filing. The bottom line is, most taxes can't be eliminated through bankruptcy, but some can. Income taxes that were due more than 3 years ago can be discharged by a Chapter 7 or Chapter 13 filing. They say that a home is where the heart is. However, when it comes to a second home, it can be where your heart is or just about anywhere else, as far as the IRS is concerned. In fact, not only can a second home be just about anywhere, it can actually be just about any structure, including a yacht or even a sailboat. That's right. Boats typically count as a second home in the IRS's book for figuring tax breaks, as long as the boat has cooking, sleeping, and toilet amenities. According to the IRS, when it comes to your federal income tax, home mortgage interest is any interest you pay on a loan that is secured by your home. If you itemize your deductions and you own a qualified home with a mortgage, you can deduct the interest from that mortgage. Likewise, for your federal income taxes, you can also deduct taxes on personal property based on the value of that personal property, including any taxes due on a boat. However, you must be using your yacht or other boat for personal use. You don't even have to stay in the boat or second home anytime during the year in order to claim real estate, property, and interest taxes as deductions. Some of the most popular countries that offer the financial benefit of having no income tax are Bermuda, Monaco, the Bahamas, and the United Arab Emirates. There are a number of countries without the burden of income taxes, and many of them are very pleasant countries in which to live. However, taking advantage of living in a no-income tax country is not as easy as packing a suitcase and buying a plane ticket. Citizens of the United States cannot escape paying U.S. income taxes just by moving to another country. All U.S. citizens, regardless of where they choose to reside, are still legally obligated to file U.S. income taxes in the same way as if they were living in the U.S. It may seem appealing, but renouncing citizenship is not an easy task. First of all, many countries do not offer easy access to citizenship. In most instances, The process is lengthy and expensive. Some countries will purposefully keep the barrier of entry high so as to only attract top investment. Secondly, U.S. tax authorities were hit hard by the loss of dozens of multimillionaires and billionaires who have chosen to obtain citizenship in more tax-friendly countries. In response, these authorities have made it increasingly difficult and expensive to renounce U.S. citizenship, imposing an expatriation tax that can become extremely expensive. There are a number of oil countries in the Middle East that have no income or corporate tax, and the UAE is considered one of the most attractive, with a relatively stable government and economy. The UAE has a thriving economy and a more multicultural environment than the majority of countries in the Middle East. This makes it the most lucrative country for multimillionaires to run to escape the high tax rate that the US imposes. For centuries, taxes have been an important fact of national life. Without them, it would be impossible to pay for the country's defense services, its health, welfare and social services, its schools and universities, and its transport systems. In addition to these huge areas of expenditure, financial support is given to other vital areas, such as industry, sport, heritage, and culture. So the million-dollar question is, why should the mega-rich not pay tax and the average worker suffer the extremely high tax rates imposed by governments? Comment down below your opinions, and don't forget to like the video and subscribe to our channel.